Do you often find yourself struggling to identify and work out whether or not a company is going to be a wonderful long-term investment for you and your family and your portfolio? Do you often find yourself doubting or wondering whether or not this is the right time to get in? I'm just going to have a quick walk through some of the key elements that I personally look for when I am looking for a company and looking for an investment. So these are the top 5 elements. Now, I don't always need all 5. Now, the other thing to remember is these 5 elements are also quite subjective. What is right for you, what meets your requirements, is not going to be the same as what meets my requirements. So, let's get into it. First of all, I want a company that's fundamentally sound, fundamentally stable. I want a company that's going to be here today, tomorrow, and 10 years from now. Of course, there are absolutely no guarantees about this, but at the same time, we can look for companies with proven track records, proven business models, which we believe will endure. Those are the companies that I'm most interested in investing in. Now, on top of this, I want to layer on an assessment of whether or not the management is doing a fabulous job. To be honest, they don't have to be doing an absolutely wonderful job, but I also want to avoid a situation where the management team is doing an appalling job. So, wrap those two together. Stable, financially secure company with a good, strong management team. Now, very closely related to this, I want a company with long-term competitive advantages. Now, the two usually go hand in hand. That first long-term track record and proven business model is often based on and built upon a stable qualitative advantage and competitive advantage over the peers in the marketplace. Now, in many cases, this could be something as simple as a huge capital investment that an opposition party is unlikely to make because of the huge and substantial risks. That gives a company with a large investment and a large footprint often quite an unassailable advantage. And we often see this particularly in an oligopoly or an oligopolistic marketplace. So if you think about air products and chemicals, APD, for example, this is a company which is one of a few players, huge footprint, huge investments in processing facilities. It's going to be very difficult for another company to come in and take that market share. So I'm looking for a company with these almost undefinable qualitative assessment of whether or not this is a good company with competitive advantage. Money, money, money. Now, one of the other benefits of these types of companies with these competitive advantages and stability and security that are going to be here for the long run is they usually pay a dividend. In other words, they can't use all of that money, all of that cash flow that they generate to grow faster, to grow bigger. In some cases, they can't grow overly fast because there's a limit on how fast that market is growing. Now, in this particular case, I'm looking for companies that are returning the dividends to the shareholders. So returning money to the shareholders as a dividend. Ideally, I want a dividend that's growing. Now, sometimes I will trade off a high dividend yield now with a low growth. Sometimes I'm looking for a slightly lower level of dividend and a much higher and faster growth rate so that in 10 years from now, I'm going to be pulling in quite a lot of dividend income from that investment. Now, closely related to that is the opportunity to find companies that are busy buying back their shares. So they're actually buying their own shares, taking them off the market, and that makes every share that I own more valuable. It also means that the same amount of money that they set aside to pay dividends is being spread over fewer shares. That means the dividend per share becomes higher as well, much more easily. So buybacks and dividend payments, that's another way that I'm looking to capitalize on these investments, and it's another big indicator for me as well. Now, as well as that, I also want to know that the dividend is going to be well covered. So I'm not looking for a company that's paying out all of their money, all of their income, all of their earnings, all of their cash flow and dividends. I want a company that's got a lot of buffer. So if there's a bad year or two or something goes a little bit wrong with the business, I don't want them to struggle to pay the dividend. I want lots of buffer there, lots of margin of safety for that dividend payment. So a low dividend payout ratio. Another element that I look for is whether or not the company has good upside potential. Now, one of the key assessments that I'm using for this is often the management guidance, so what the managers are guiding. Now, yes, they are absolutely biased. There's no doubt about that. But as well as this, I also like to look at the analysts and the analyst expectations of, for example, earnings growth or sales growth moving forward. Yes, analysts are also biased, but in many cases, they understand the company, they understand the industry, they understand the dynamics, they understand the macro environment, and they've got the time and the energy to drill into this in a lot of detail. Now, if they are not positive about those long-term upside potential for this company, I'm probably not going to spend too long looking at it. I don't always agree with the analysts who say there is a very strong upside as well. I do my own homework, but if they are not positive about the upside, generally I'm not going to give this investment opportunity too much more of a second chance. I'm just going to quickly skip through it. I've had a lot of criticism and questions about my use of the analysts, and this is one of the key reasons I use them, is to understand what they think is going to happen to sales, what they think is going to happen to earnings, what they think is going to happen to, say, capital expenditures or interest costs moving into the future. Some tools like fast graphs enable you to very rapidly and quickly assess the overall analyst accuracy. And fast graphs has a 1 and a 2 year scorecard, which means management is providing good guidance as the company is stable and predictable.